What if I told you that a company sitting on over $6 billion in free cash flow is trading like it's on life support? PayPal, the original fintech giant, has cratered 83% from its peak. Is this the buying opportunity of the decade, or is the market seeing something we're missing? Welcome to Smart Stock Sam, where we decode Wall Street's biggest moves so you can invest with confidence. Today, we're diving deep into PayPal's latest earnings report to answer the question every investor is asking: should you buy now or wait for even lower prices? PayPal is currently trading at roughly $42 a share, a staggering fall from glory. But here's what makes this fascinating. The market isn't just pricing in a rough quarter. It's pricing in a fundamental transformation, where a former growth superstar is being reclassified as a stagnant utility. The Q4 2025 data just dropped, and it explains exactly why smart money is heading for the exits. We're witnessing what analysts call a structural derating in real time. But to understand why this isn't your typical buy-the-dip scenario, we need to examine the identity crisis tearing this company apart. PayPal is trapped between two worlds. It's no longer the disruptive innovator that revolutionized online payments, but it hasn't quite transformed into a boring, stable utility yet. The company's core engine, that iconic PayPal button you see at checkout, is failing to defend its territory against tech giants like Apple Pay. And here's the kicker: even a massive 15% buyback yield starts to look like a value trap when the underlying asset you're buying back is constantly shrinking. Could PayPal actually engineer a turnaround, or are we watching the slow decline of a legacy platform? The recent earnings report might have shown a technical beat on some metrics, but we need to look closer at what Wall Street actually cares about. On the surface, the Q4 numbers look mixed. Revenue came in at $868 billion against expectations of $875 billion, a miss. Non-GAAP earnings hit 123 versus the 129 consensus, another miss. But here's the critical miss that has institutional investors hitting the panic button. Branded checkout grew at just 1%. Let that sink in. The historical trend is 8% growth. Management spent all of 2025 systematically lowering the bar, recalibrating expectations downward quarter after quarter. And even with those dramatically reduced expectations, they still managed to trip over it. But wait, didn't they report a beat on GAAP earnings? This is where the accounting sleight of hand comes into play. That reported $1.53 in GAAP earnings? It's what we call a cosmetic beat. When you strip away the one-time tax benefit from legal restructuring and some fortunate gains in their investment portfolio, the operational reality is that thinner 1.23 figure. The business is under significant margin pressure. Once you peel back these non-operational layers, you see a business that's effectively stagnating. The GAAP tax rate came in at 11.7% versus the expected 25.4%. That's not operational excellence, that's accounting engineering. Now let's examine the specific trend that is keeping PayPal's board of directors up at night. This is the decay of the PayPal button. In just 12 months, branded checkout growth crashed from 6% down to that alarming 1% we just mentioned. Whether it's low-income consumer weakness in the US, economic deceleration in Germany, vertical normalization in travel and crypto, or slow merchant adoption, PayPal is losing its pricing power and its relevance in the checkout flow. The question is, can they reverse this trend before it becomes terminal? But the real reason customers are abandoning the button isn't just macroeconomic headwinds, it's a massive experience gap. We're witnessing what I call a competitive presentment crisis. Think about the user experience. With Apple Pay, you get biometric authentication, one tap, and you're done. Frictionless, instant, secure. PayPal, on the other hand, is stuck in a bygone era, forcing users through redirects, login screens, password entry, and two-factor authentication. In the world of mobile-native shopping, friction is the enemy. Every extra click is a conversion killer. PayPal is currently losing the battle for what matters most, becoming the customer's primary choice at checkout. So how does a struggling company fix a broken product and a lagging culture? They bring in what I call an architect of austerity. Enter the new CEO, Enrique Lores, effective March 1st, 2026. Coming from HP, Lores has built a reputation for prioritizing margin protection over aggressive growth. During his tenure there, he eliminated between 4,000 and 6,000 jobs to save $1 billion. We're predicting a similar playbook, aggressive restructuring of PayPal's 30,000-person workforce. The goal here isn't to innovate our way out of this mess, it's to cut our way to profitability. Margin protection is now the priority over growth. But can cost-cutting alone save a company losing relevance? Cost-cutting is only half the equation. They also need a desperate pivot in how they actually show up for customers. The new game plan is essentially a game of catch-up on 3 fronts. First, experience. Racing to get 50% of checkouts biometric ready by the end of 2026 to compete with Apple. Currently, they're at just 36%. Second, presentment. Fighting for upstream placement. Basically, lobbying to move that PayPal button higher on the web page so you see it first. Third, selection. Abandoning the optimize for everyone strategy to focus exclusively on the top 25% of strategic merchants. It all sounds logical on paper, but will it be enough? And more importantly, will it happen fast enough? The current market valuation, however, tells a much darker story about PayPal's future. We're facing what I call the valuation paradox. Under normal circumstances, a PE ratio below 10x, combined with over $6 billion in free cash flow, would scream buy to value investors. But in this case, those metrics are signaling structural decay. The market is pricing PayPal as if that cash flow is destined to evaporate as the core business continues to shrink. The PE ratio has collapsed from 20x down to 9x, not because the stock got cheap, but because the market has fundamentally re-rated what kind of company PayPal is. If the core business is shrinking, what is management actually doing with all those billions in cash? They're caught in what I call the buyback dilemma. PayPal is executing a massive $6 billion buyback program, which mathematically concentrates your ownership percentage. But here's the problem. If you're concentrating ownership in a decaying asset, is that actually creating value? Even the new $0.14 per share dividend feels more like a price floor mechanism to attract yield-starved index funds rather than a signal of genuine growth confidence. While the core business struggles, there is one hidden area that's actually performing remarkably well. Venmo remains a genuine bright spot, with revenue up 20% year over year and a massive strategic shift underway, from simple peer-to-peer payments into actual commerce. Meanwhile, Braintree is successfully doubling its processing yield by pivoting away from destructive price wars and into high-margin, value-added services. These are real wins. The question becomes, can these secondary engines grow fast enough to offset the rot in the core before AI fundamentally changes the game? PayPal is betting its future on what they call agentic commerce through AI partnerships with Microsoft Copilot and Perplexity. The problem? This is defensive positioning, not offensive innovation. We don't expect to see material impact on the bottom line from these AI integrations until late 2027. For many institutional investors evaluating their positions today, that timeline is simply too little, too late. The market moves faster than product roadmaps. So if you're looking at that $40 price tag and feeling tempted to buy the dip, here's the exact framework you need. Do not buy the dip until these 4 critical milestones are met. First, branded checkout growth must return to mid-single digits. We need to see sustainable momentum, not just a one-quarter blip. Second, biometric adoption needs to cross that 50% threshold. Third, the transaction take rate must stabilize at 1.65%. Fourth, we need confirmation of those major headcount reductions actually happening. Right now, the status is pending inflection. None of these boxes are checked, which brings us to the final verdict on the stock. The hard truth: PayPal is likely dead money for the next 12 to 18 months. While fintech competitors like Sophie and Robinhood have delivered positive returns over the past 5 years, PayPal is down 83%. That's not volatility, that's value destruction. Our rating is a firm neutral, or hold if you already own it. We're staying on the sidelines until we see concrete proof that the austerity architect can actually turn this ship around. The risk-reward just isn't there yet. Finally, this content is for informational and educational purposes only and does not constitute financial advice. Always conduct your own research and consult with a qualified financial advisor before making investment decisions. Past performance is not indicative of future results, and all investments carry risk, including the potential loss of principal. If you found this analysis valuable, smash that like button and subscribe to Smart Stock Sam for more no-fluff stock breakdowns. Drop a comment below. Are you buying PayPal at these levels or waiting for more clarity? I'll see you in the next one.